The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Optimism works its way back into financial markets as stocks and bonds stage one of the strongest rallies of the year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Raymond.
And I'm Alex Steele. Happy Tuesday if you're a long investor in the equity market.
Oh, thanks for reminding me. I was going to say it was Monday.
Oh, yeah, no, it's fair enough. It was a dicey pick there. All right, let's take a look where we're headed into the close. Just three basic assets to show you where we're at. You got to buy equities, you got to buy bonds, and you got to buy the dollar. All of that moving together. So it feels like we're in a buy the U.S. phase right now, particularly when it comes to tech, Romain. But my question is, can that really last?
Yeah, it'll be interesting here, but the optimism is here, at least for this day, and it really began on Sunday with the U.S. government's one-month reprieve on opposing higher tariffs on the European Union. Now, of course, we've been here before, so add the grain and salt, if you will, but the chatter on Wall Street is that the trade war does start to feel a little bit toothless now, and the contours of other policies emanating from Washington suggest, at least for some, that the darkest days may have indeed given way.
Nothing's really changed in the economic environment. You just have policy uncertainty. And I think people are just going to wait policy uncertainty out. They do think there's a light at the end of the tunnel, that there will be some certainty, whether it's the tax bill or some of the trade terms. But I think they're just waiting it out.
And as far as that light goes, consumer sentiment, which correlates strongly with consumer spending, has indeed rebounded. The latest Conference Board data shows this month's stock rally and the tamp down in trader rhetoric did put consumers in a better mood to spend, though it does come with asterisks, including the continued deterioration in the consumer outlook for the labor market. And we're going to get a better non-survey read on the consumer this Friday when monthly PCE data that is projected to show a dip in both personal income and personal spending. That seems to be what the bond market is focused on. While appetite to buy U.S. government debt is on display today with the solid sale of two-year notes, the premium that investors are demanding to be locked into anything longer than that still remains at the highest, Alex, in 11 years.
That's right. And even though we're seeing sort of volatility come down in the equity market and equities rise, there are still some question marks within the volatility for FX and the bond market. And that's the chart that you're looking at now. In particular, take a look at that green line. That's FX volatility. Sure, it's coming down, but it remains pretty elevated. And that white line is bond volatility. It's the MOVE index. You can see it ticking up just a little bit, meaning that if other U.S. asset classes continue with this kind of volatility, will that eventually continue to infect the equity market?
And as we kick things off here on this Tuesday afternoon to these closing bells, let's bring Tony Rodriguez into the conversation. He's the head of fixed income strategy at Nuveen, and he joins us here in Studio 2. Great to see you, Tony.
Good to be with you.
What does the fixed income market feel like to you today? Is there a little bit more optimism than maybe where we were, a couple months ago?
I think there is a little bit more optimism. It's certainly a calmer market. You know, we had a couple of things you mentioned. Certainly the data was supportive. We had Japan over the weekend, which a lot of this kind of emanated last week in Japan with a kind of a weak auction and fears and concerns there. So they kind of walked back a little bit. That eased some of the fears. But I think right now the uncertainty level is still what is most dominant in that we're settling into a range that feels very tenuous because there's still so much uncertainty, not only about where tariff policy will end up, but then because it's such an unprecedented level that we haven't seen before, what is the actual economic impact going to be on consumers, for example?
But how do you assess that? I mean, you go back to Friday when we started the morning with Trump basically threatening 50% tariffs on the EU. By the end of Sunday, basically that was off the table, at least until early July. But of course, even if he doesn't go through with the 50%, in theory, we're still going to end up with tariffs meaningfully higher on the European Union than where they were, 4 or 5 months ago. So how do you even assess that as a bond strategist, a bond investor?
So, A, it's very difficult, but what we're thinking is that we're going to end up around this kind of 10% tariff broad level with some very specific industry tariffs at maybe 25%, China a bit higher. That's what we're modeling. That alone leads to growth this year that is down to 1% growth in the U.S. So with that is where we start to say you're going to see maybe towards the end of the year a bit of a decline in rates. You'll begin to see towards the end of the year the Fed begin to start a little bit of easing because of that softness from the economic perspective. And from a credit risk perspective, you may begin to see a little bit more softening, maybe a little bit higher defaults, a little bit more weakness in terms of financial statements from companies. So that could lead to a little bit of a mini risk off. We're not thinking recession, but we are thinking there's going to be this slowdown from those tariffs.
So looking at the bond market in the long end, I was mentioning that volatility. We're at that 5% level. We're at the lowest level for yields in the 30 years since March, but that's whippy. I mean, last week is a very different story. What kind of volatility becomes really negative for other U.S. assets?
So right now, we would say that the volatility is already negative for U.S. assets, but has the potential to get worse. Because right now what we've seen is, hey, throw out a large number on tariffs, kind of pause it, walk it back. But where we're going to have the most difficulty, we think, in terms of actual trade negotiations, finalizing in a deal, are with the largest trading partners. So with Europe, with China. UK, that was a fairly easy example for a number of reasons. Now I think is when it gets really difficult. And so therefore, we think this volatility is likely to return with greater intensity as we move into the fall.
As in, like, the UK didn't have a deficit with us. So that was probably why that was so it changed.
Exactly.
Okay, so the volatility winds up picking up. Where in the credit market and the treasury market then becomes a safety, nice yielding play? Sure.
So when you think about like the treasury curve, we do think that the intermediate part of the curve is pretty well positioned. There's some stability there because we do think the Fed will start to cut rates, where the long end has a little bit more risk because substantial deficits coming from the tax bill, et cetera. Where we think from a sector perspective, we do think that the municipal market is pretty attractive because it's somewhat insulated from the tariff story. We think financials are in pretty good shape, strong balance sheets, not quite as much exposure directly to industry-specific tariff levels. So think of the preferred market. And we do think that floating rate assets are attractive because we're not expecting a big drop in rates. We're not expecting a huge cuts from the Fed. So floating rate assets at the higher end of the low quality spectrum can still generate 6.5% to 7.5% returns. That looks pretty good relative to where we think equities and other assets are.
Even in sort of a range-bound market.
Exactly.
Really interesting. And on the Fed cuts, though, I mean, when you say the Fed starts to cut, that sounds like you're anticipating multiple cuts this year?
We are. We think that we might get 2 this year, maybe start in September, could be delayed to October. So we get 2 this year. Next year, it's kind of a question as to whether they stay there because the economy proves to be more resilient than our 1% forecast. If we're right, we'd expect to see another 2 cuts next year, getting down to kind of a final equilibrium level in the low 3s for the funds rate, and the curve being steeper than historically because of all the pressure from high deficit levels, high borrowing needs.
One last quick question, and this is kind of on some of the moves we've been seeing in the bond market globally. Is this in sync? I mean, should we be drawing a line between some of the moves that we saw here in the U.S., what we're seeing in Europe, what we're seeing in Japan and elsewhere, or are these all sort of their own independent stories?
There's a little bit of both. The in sync part is that tariffs are really the dominant economic factor, and all of these regions are dealing with that. And really related to some of these tariff policies are things like Germany and Europe suddenly deciding they're going to loosen up on their fiscal kind of break and they're going to spend more on defense. So that leads to this whole similar kind of rise in the term premium, high levels of borrowing needs, and that requires higher rates. So very similar, but there are some unique circumstances to each country.
All right, Tony, always smart. Tony Rodriguez, head of fixed income strategy at Nuveen, kicking us off to the close here in this Tuesday afternoon. A conversation about proxy season coming up next. This is Bloomberg. All right, as we wind through the proxy season, the Trump presidency has actually brought with it a proxy battle slowdown. The numbers are down annually for proposals related to things like climate, ESG, executive pay. But with battles like Elliott and Phillips 66 playing out as we speak, we want to get an outlook on the rest of the year. Liekefett joins us right now. He's partner and co-chair of shareholder activism and corporate defense practice at Sidley, Austin. And we should point out that Bloomberg does rank Sidley as #1 when it comes to legal shareholder activism defense in North America. Great to see you.
Thanks for having us back, and thanks for having such excellent data to underline our prominence in the sector.
Well, let's talk about this data, because there's been a lot less data coming out. I mean, there was a slowdown in activity to start this proxy season. I know we're not quite all the way through it, But the numbers are clearly down. And I am curious if there is a direct link between some of the uncertainty that was coming out of Washington and the inability of shareholder activists to really agitate for anything out of companies in this environment.
That's an excellent point, Romain. And it is true. The Trump administration had a big impact on this year's proxy season. Now, stepping back to in November of last year, activists were popping champagne when Trump was elected. Why? Lower taxes, deregulation, easier path to M&A, all of this fueled shareholder activism. But apparently the activists didn't listen to everything Trump was saying because they overlooked the fact that Trump was also talking about tariffs.
Yeah.
And once Tariff Liberation Day came, that really was a shock to the system. I mean, we, in our practice, at least 14, maybe 15 of our proxy fights were abruptly withdrawn or settled after Liberation Day, because the market turmoil made it really, really hard for activists to make money.
Do you get a sense, though, that some of those proxies that were withdrawn, that they could be reintroduced in the next go-round, or is this kind of the moment has passed?
Well, if those companies don't perform, the activists might be back next year. But I mean, a lot of activists decide, okay, this is not the time to go after management teams in a public way, when all management has to say is, look, we need to focus on the supply chain right now.
Gotcha.
Right. It's like also going after like a retailer during cold weather season. Well, it wasn't that cold, and then you can't have a conversation. Is there one sector that you feel like is riper than others for activists right now?
I think there's been one sector that has been overlooked for several years, which is insurance and the financial sector. I think with deregulation in these sectors, we're going to see more activism. So far, we had only a handful of activists who really focused on this sector, like Elliott, Third Point, and Carl Icahn. But I think we're going to see more of that going forward.
Speaking of Elliott, Elliott's been busy. They just won 2 board seats at Phillips 66. They're also in BP now and increasing their stake there. What did you make of the outcome with Phillips 66? 2 board seats, that's it.
Well, that was a big win for Elliott. Look, this
Didn't they want like 8 or something?
Well, they wanted 4.
Okay.
They could only get 4 because Phillips 66 had a so-called classified board where only 1/3 of the board seats were up for election. So they won half of those seats. And that was the first time Elliott took a proxy fight all the way to a vote. And the interesting part here is this was a shareholder base that is a defense lawyer's dream. You had 30% retail, 24% were held by the big 3 index funds, BlackRock, Vanguard, State Street. I mean, it was very difficult to lose any seat on behalf of the company. Still, Elliott managed to get 2 seats. And in fact, they came very close to a 3rd seat, if my information is correct. Only one investor could have turned things around. So it was a big win for Elliott. And the reason why they won this proxy fight is because the company made a lot of unfortunate mistakes. And I mean, just generally speaking, when you're defending proxy fights, you need to be a little bit like Iceman in Top Gun, right? Make no mistakes. And and rest in peace, Val Kilmer here. But the point of the matter is the company made a lot of unfortunate mistakes. For instance, they put out questionable numbers that could easily be disputed. They didn't send all of their director nominees into meetings with ISS, which gives very influential vote recommendations.
Right.
It was really a series of questionable choices that led to this defeat.
I'm curious, there's another battle that was going on, and that was between Beacon Roofing trying to fend off a takeover by QXO. I don't know if you have a movie analogy for that, if like Brad Jacobs like hanging from the Burj Khalifa like Tom Cruise or something. But he appears to have won this. I mean, right, they did come to an agreement, and we should point out you were involved, you and Sidley were involved in that process, correct?
Yeah, I was leading the legal defense of Beacon Roofing Supply. It's not all said and done. The deal closed last month, so I think I can talk about it. Was a fascinating battle, was the largest hostile takeover tender offer in the United States with $11 billion. And the board venture went essentially from hell no to hell yes, where can I sign, within 2 announcements by Donald Trump, right? I mean, the market turmoil certainly helped Brad Jacobs. It made what one analyst called a B+ offer to become an A offer, right? That's really the story here.
wrapping it up, I want to go to BP for a second. You mentioned Phillips 66. You mentioned QXO. Thank you. BP has Elliott now. What took so long to get an activist investor in BP? And how is that different than, say, other activist investors in other companies in the U.S.?
Well, it's one important difference, and it's the first letter in BP. It's British, right? They're in the UK. They're located and in that jurisdiction. And it's really hard to run proxy fights in the UK. It's a different legal framework. The investor sentiment is very different. And let's not forget, BP is a national icon. I mean, it's literally in their name, right? And 50% of their shareholder base is retail. So if you think that Phillips 66 was a defense lawyer's dream, I don't want to even talk about BP. It's almost a proxy fight you cannot lose as a company. Still, I think BP, based on what we read and what I hear from friends surrounding the company, I mean, they've been very receptive. And look, it's just a reality of life. Elliott is oftentimes right. Not always, but they're oftentimes right. And I think the points they raised were largely agreed to by the company, and I think they're working constructively.
All right, Kai, always a wonderful conversation with you, always great insights. Akayla Liekefett is a partner and co-chair of shareholder activism and corporate defense practice over at Sidley, Austin. When we come back, we're actually going to continue talking M&A. Maybe it's M&A. U.S. Steel, those shares rising here on the back of an announcement by President Trump about a planned partnership with Japan's Nippon Steel. We're going to speak to a key analyst in this space, get her take into, well, just how real this is. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with CoreWeave. Barclays cutting to equal weight. In fact, it's the first downgrade since the cloud company's IPO. And despite raising its price target to $100 from $70, the firm says the short-term upside is limited given the recent rally. Long-term, though, Barclays is still optimistic on CoreWeave's role in the new generative AI world. Those shares still on a 2-day win streak right now, and they've almost tripled since it went public in late March. Up next, Southwest Airlines, Jefferies upgrading to hold, boosting the price target to $33 from $24, with the analysts citing growing confidence in realizable initiatives for the airline, like cuts to underperforming cities and new connections elsewhere. Those shares having its best day going back to April 9th. And finally, U.S. Steel, Wolfe Research cutting to peer perform. Now, that note was published after Trump announced a planned partnership between U.S. Steel and Japan's Nippon Steel on Friday. That's a deal that the analyst considers negative for sheet mills, saying it will create excess supply. The shares of U.S. Steel nevertheless up about 2% on the day, and those are some of our top calls. We do want to stay on that last one and take a deeper dive into what exactly is going on with U.S. Steel. Timna is metals and mining analyst at Wolfe Research, and she joins us now. All right, Timna, there's a lot to unpack here. You had Trump on Friday saying there was some sort of partnership going on between these two companies. Today, there's been reports both from CNBC as well as Bloomberg citing that this may actually involve some type of an actual sale of the company to Nippon. What do you know?
Hi, I think it's really a function of President Trump not wanting to explicitly say that he's done a U-turn on his prior opposition to the deal. And so now pitching it as if this were something kind of different than what it was intended to be all along. And I think it is going to be a takeover of U.S. Steel by Nippon. The headquarters was always going to be remaining in Pittsburgh, and leadership would remain in the U.S., kind of a Nippon USA. But I think it just kind of sugarcoating what will be probably what was initially pitched, the takeover of U.S. Steel by Nippon.
One interesting wrinkle to this, according to Bloomberg reporting, cited people familiar with the situation, is the idea that the U.S. government would actually have a shareholder stake. In fact, some degree, I guess, of a controlling shareholder stake, at least when it comes to decision-making power. Does that make this a better deal?
Well, it's certainly unprecedented. I don't even know what to make of that. I've never had a company in over a couple decades of covering the space where the government could decide whether or not they produce or, help them make decisions. So I don't even know what to make of that, honestly. I think broadly speaking, the only government interest would be just in the union maybe, which already has opposed the deal, or keeping them producing perhaps to try to keep the price lower. I don't know what other interest the government would have in the space, but I think it was intended to be a sweetener to get the deal through in the last couple weeks.
There's also rumors of a new investment of $14 billion from Nippon Steel to U.S. Steel that could result in a new steel mill. A new steel mill? Like, A, do we need that? And B, is that realistic?
I absolutely could build a new steel mill. There's nothing stopping anyone from putting it in the ground and adding capacity, although we think there's plenty of it and could be excess in our sheet storm thesis. But yeah, absolutely. I mean, Nippon has been pledging more investment as, again, part of getting this deal through. And the sweetener, $14 billion, to your point, could be a brand new steel mill and could be enhancements of the existing assets that have been kind of underinvested in U.S. Steel over the years.
But do we need it on a supply and demand basis?
No, our analysis says no. I mean, there is quite a bit of new steel capacity coming from existing players over the next several years across sheet, rebar, plate, and galvanized. But, could be taking more share from imports. We think imports will take a smaller stake in the market given the Section 232 tariffs. But we ultimately see risk of oversupplying the steel market and certainly by the end of the decade, taking share perhaps from existing players even.
So, I mean, what does this mean? I mean, if we just assume hypothetically that this does go through, does this make U.S. Steel then, just strictly from a financial standpoint, does this kind of make this a little bit maybe of a worser case for the company? Is this going to put the company, I guess, in a worse financial position long term?
Well, I think this will be a cash infusion in U.S. Steel, so they'll be more competitive longer term. I mean, the debt for the combined company, given, almost $30 billion of investments for the acquisition itself and then further investments, that's Nippon Steel's issue. But I think that U.S. Steel is a standalone. Well, it won't be a standalone, but U.S. Steel within the broader Nippon Steel will be more competitive, lower costs. They'll have probably greater capabilities, and so will make them, more competitive, but also could be threatening to other steel mills that don't have the wherewithal to make those investments longer term. So we think the broader steel market implications is lower price for longer, more supply in the market, but a more competitive and capable steel industry longer term.
Where does this leave the likes of Cleveland-Cliffs?
Cleveland-Cliffs is a company that doesn't have the same wherewithal to invest in their assets. That's why I think they will be challenged to stay competitive. As it stands right now, they have not the same bandwidth for investing in assets that in many cases are over a century old. They are competitive with U.S. Steel for now in exposed automotive, but there are quite a few players gunning for producing that same product. So I think by the end of the decade, there'll be a lot more supply gunning for that same tonnage and a lot more options at lower prices for the auto industry.
All right, Timna, always a pleasure. Really good to chat with you. Timna Tanner's metals and mining analyst, one of the best out there at Wolfe Research, joining us there on U.S. Steel. But the sweeteners are so interesting, and you could see that also with the talk between President Trump and Ursula von der Leyen of the EU, right? Like the sweeteners and just having like a good conversation and putting some overtures out there makes a huge difference when it comes to President Trump.
Yes.
Cool. Okay, coming up, a conversation with Chad Tredway, the global head of real estate for JPMorgan Asset Management, his perspective on REITs and where to invest in data centers and what the impact of tariffs could actually be on the real estate market. You take a look at rates. Yes, they're coming down, but they're still a little sticky, around 5 percentage points for that 30-year. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. The equity rally underway, really seeing it play out within the NASDAQ, particularly the Mag 7, that sort of AI theme headed into NVIDIA earnings tomorrow, and that sort of U.S. exceptionalism theme alive and well in the technology space. Yeah,
you're seeing the Philadelphia Semiconductor Index up 3%, really leading the charge here. And that's all everybody seems to want to invest in. There was a great story on the Bloomberg earlier today about Chamath Palihapitiya, of course, over at SoCal Capital, and of course, a very early investor in Facebook, which is how he made his money. Big land deal out in Arizona here. And it's not just for the data centers themselves, but there's a huge power component in all this where he can seize some of the power in there and kind of, I guess, resell it to some of these data centers as well.
21-acre land deal, huge data centers, and then upwards of 1,500 megawatts of power. What's interesting, though, is that at some point you're going to move from the large language models, huge mega data centers, into smaller, close to the source inference modeling. And that's going to be different power. That's going to be a different landscape. And I just wonder where we are in that shift.
Yeah, I don't know. I know we've reached out to Chamath for comment. Of course, he's declined so far, but we'd love to have him on the show.
Oh, shameless plug.
Explain. Yeah,
all right, well, joining us to discuss the perspective of investing in
Alex,
data centers as a real estate play is Chad Tredway, the global head of real estate for JPMorgan Asset Management. Chad, always good to see you.
Great to see you.
So that's the data center pitch, right? Are you guys invested in data centers?
So first, there will be winners and losers in data centers.
Yep.
And we study the space incredibly closely. What we're seeing, though, is data centers have a lot of components. So first of all, in our portfolio, the average industrial site is roughly $200 per square foot. Data centers, $500.
Wow.
So 2/3 of a data center is actually the power, the technology, and everything that goes along with the data center, not the real estate. So for us, we've gone more pure play real estate, but we do see technology in other places like manufacturing, and we're buying a lot of industrial focused on robotics, manufacturing, and how do you make goods cheaper and faster all around the United States.
Which maybe the data center will use those things then in its production. So when you say pure play real estate, what does that mean?
So we love housing. We talked about it last time we were here. We think there's a structural just demand for housing. Over 5 million housing units are what we're going to need to satisfy the demand in the United States. So we're seeing residential rents continue to grow. Additionally, everyone talks about industrial, but what they miss is what's actually happening with the CHIPS Act. So if you look at the CHIPS Act, there's over $1 trillion of investment in California, Arizona, Texas, and New York, all driven towards manufacturing. So just to give you an example, we have a site in Torrance, California. And it's really hard to find manufacturing talent. So what happens? You have to use robotics for efficiency. And we have 4,000 amps of power in our site. A traditional industrial site is 500. So it's a big trend and something that people should be focused on.
What's the growth rate look like long term, particularly when it comes to manufacturing of robotics and other kind of high-tech areas similar to that?
It's huge.
Yeah.
So as you know, American exceptionalism is something that's happening. The new administration is very focused on things made in the United States. Manufacturing demand is at all-time highs. I think there's a recent survey from Deloitte that said you need 3 million more workers just in manufacturing to meet demand.
Yeah.
So for us, we're focused on everything from supply chain to the actual manufacturing facilities.
How do you
for our
determine,
investors.
though, geographically, where to make that investment when it comes to robotics and all these things, particularly if there aren't as many humans involved? What's the decision process?
Again, a lot of times you follow the dollars.
Uh-huh.
So most people are talking about investment, but they aren't talking about the Inflation Reduction Act or the CHIPS Act. Again, Texas, Florida, Arizona, the Sun Belt, New York, those are places that have capital. And what you're seeing is investment come out of that for makers of technology in addition to other manufacturing goods.
Does any of that change if the back end of the bond market yields stay high?
Higher for longer, that's what everyone's saying. I think a couple things happen. So one, obviously our cost of capital is higher, but that also means home affordability is just much more difficult. So if you look at it now, the parity between owning or renting, it's 50% cheaper to own a home today, or it's 50% cheaper to rent a home today than to own, which is the highest it's ever been. So if rates stay higher for longer, that imbalance will continue.
Oh, Raymond, sorry. He's renting and looking for a house. That's the last thing you wanted to hear. Another trend that we tend to talk a lot about is senior living and student housing, and those two being some, good trends, never going to go away in the industry. Do you agree with that?
We love it. So we look
you do? Okay.
We look at both student and senior. The demographic trends just say it's a great place for rent growth. I think really, though, the main focus here is picking the right partners. So what's nice is we've got a lot of partners that we've dealt with over years, and we're able to really focus on the right assets in the right markets.
So when we get back to this idea of finding these opportunities and the competition for them, I am curious what that looks like. I mean, you started off with that great anecdote about the differential that you're seeing in square footage prices for data centers, because obviously everybody's going in that direction. But some of the other areas that you are invested in are also, it's no secret that these are hot areas, at least from a long-term trend perspective.
Look, it's frothy.
Yeah.
One of the advantages we have, though, is 1 out of every 2 Americans are JPMorgan clients. So we've got data on where people are going, migration trends, investment, household formation.
Yeah.
It's been huge for us. I think the other thing is we've been around for over 60 years. So not only do we have macro themes that we work on top of house, but we also are on the ground in these markets every single day. And we've got an $80 billion portfolio around the world and over 10,000 clients across the bank.
I do have to ask you, though, about the political side of all this. I mean, when we talk about macro themes, you can't really talk about that without talking about what's going on in Washington. You mentioned the CHIPS Act and the IRA. You have an administration that is pushing policies, in some cases, that would roll back some of those provisions from previous administrations. So how do you model, without getting too deep into politics, how do you model for the uncertainty of Washington policy right now that is short-term in nature but could have long-term impact on your market?
It's a great question. We're long-term investors. So first, we model every outcome. but we look at the fundamentals. That's what's great about real estate, which is cash flow. How do we create returns for our investors, and how do we do it using our unique advantages? One of them is just supply demand. So we know we need 5 million houses in the United States just to meet demand. It's undersupplied, will continue to be. I think secondly, we just look for fundamental shifts and imbalances. We look for the most fragmentation, and that's where we go and find value. For example, looking at industrial, but looking at it slightly differently. Who's manufacturing? Why are they manufacturing? How do they do it using technology versus just a big warehouse in the middle of nowhere?
But to Romain's point, I'm assuming you're staying away from anything that may have to do with production tax credits or other tax credits, right, that could go away. I'm just thinking of solar. Like, if you had bet on sort of a solar farm or some kind of property with solar, that's out the window now.
Look, it depends. So we do look at solar, we do look at ESG, but a lot of times it's got two benefits. So yes, it's good for the environment, but it also lowers costs, which drives return for our investors. And typically it's a two-sided investment. One, are we doing the right thing for communities, which we always will, but two, how does it drive great returns for investors over the long term?
All right, Chad, I have to leave it there. Always a great conversation. Always great to talk to you. Chad Tredway there. He is the head of Real Estate Americas at JPMorgan Asset Management. All right, when we come back, grab your popcorn here. It was a big weekend, big Memorial Day weekend for Hollywood. We're going to talk about the big box office take and take a closer look at, well, what's ahead for the weeks to come. That's coming up next in our Stock of the Hour. This is The Close on Bloomberg.
AMC stock up over 22%. U.S. and Canada box office revenue coming in at a record for the Memorial Day holiday weekend. All the other movie theater stocks up as well. Joining us to break it down for today's Stock of the Hour is Bloomberg's Thomas Buckley. Hey, are we surprised by this number, or where were expectations?
I think, expectations were certainly lower than this. I'm not sure they were necessarily entirely surprised on the basis that these were two extremely popular films, really providing something for every quadrant of the family, and the diversity of the films and their success to date, critically and commercially, has resulted in the numbers that we've seen today.
So, break down the first one. Let's start, of course, with the real winner, which is Lilo and Stitch. Sorry, Alex. So when we talk about the appeal, particularly of a movie that's aimed at families, aimed at kids, was that sort of designed to do better? The idea that, if kids want to see it, you're pretty much going to have to take your child. And of course, you got to drag the adults along with them. So ergo, you get a better box office sales.
I think that's certainly the case. It's really interesting. Lilo and Stitch has been one of Disney's most successful franchises in recent decades. Even last year they sold, I think it was $2.6 billion worth of merchandise associated with the franchise. So it's very clear that for many children and families, this became a must event.
Right. But it was a little controversial. Doing a live action version of it. And I think when the previews first came out, there were a lot of derision, if you will, on social media.
Well, it's true the animated property is incredibly beloved, has been for decades now. I think that, Disney has leaned into live-action films. Some of them have seen success, others less so, but certainly this one is seeing gigantic success and appeal.
It's like when they did live action for Lion King. It's like, okay, but they actually weren't lions, so let's not, it's like a little bit of a live action, quote unquote. I'm curious that Lilo and Stitch beat Mission Impossible, which I did see. How do we feel about that? Like, this is the end chapter to Tom Cruise's Mission Impossible legacy. It got beat out in the first one to Barbie and Oppenheimer, and then it gets beat out for Lilo and Stitch.
It's really interesting. I think that even though we have a sort of number one, number two narrative, nonetheless, it's a record for the franchise, for the Mission Impossible franchise, for Paramount. I think also, perhaps Lilo and Stitch has an advantage in it being a shorter film and therefore able to slot more theatre screenings with its shorter runtime. And I think we'll have to see how these films leg out over the coming weeks. I still think the Mission Impossible film is going to have tremendous appeal in the months to come.
Yeah. So what's next here? I'm kind of looking through the slate, and it looks like we got to wait on maybe a few more weeks here before we get back to some of the really big movies. I'm really excited to see that F1 movie. But what's kind of the next big thing that Hollywood is kind of hanging its hat on?
I think certainly the coming months have some incredible, potential ahead. We are thinking about F1, for example, the film that you raised, that's being made by Apple and distributed by Warner Brothers. We also have a new Jurassic Park film that I think is going to perform very well.
Is that animated or live
in
action?
July. That'll be live action. A lot of it filmed in Thailand. I think that's going to be an incredible picture. We also have Superman from Warner Brothers coming out July 11th. So certainly a number of titles that could drive the summer box office up to about $4.2 billion domestically.
I mean, anecdotally, when I saw Mission Impossible, Tom Cruise comes on the screen for a good 5 minutes being like, thank you for coming to a movie. Movies are important. Thank you for doing this, blah, blah, blah. I appreciate you. So that accounted for the 3-hour running time of the movie. In terms of stocks, when we're taking a look at what benefits, we obviously have the movie theaters benefiting. What are some of the other beneficiaries here?
I think certainly so movie theaters being an important part of it, as you said. I think also, makers of the technology that's licensed to theater operators such as IMAX are doing very well today. IMAX contributed 20% of the domestic box office for Mission Impossible this weekend, and we're really seeing the stock respond today.
All right, Thomas, really appreciate it. Thomas Buckley of Bloomberg joining us. I'm assuming that you didn't see either of these movies.
No, but I'm informed by my son that apparently we have to see Mission Impossible part 15.
Okay, it's technically part 8, but it's part 2 of number 7.
Right. So we will go see that.
Okay.
I'm sure. I don't know about. He's a little too old for Lilo and Stitch, but.
Well, okay, yeah. Fair enough. I mean, it's 3 hours, so.
Yeah. Okay, that's fine.
Prepare
I can always use a good nap.
Oh, so. I mean, it's all right. My daughter made it through. You'll be fine. All right. We're about 15 minutes away from the closing bell. Here on this Tuesday, Holly MacDonald, Chief Operating Officer with Bessemer Trust, will be joining us to the close. As we look on this Tuesday, a big rally underway, over 2% for the NASDAQ.
We're settling into a range that feels very tenuous because there's still so much uncertainty, not only about where tariff policy will end up, but then because it's such an unprecedented level that we haven't seen before, what is the actual economic impact going to be on consumers?
Tony Rodriguez over at Nuveen talking about that tight range that we're seeing right now in the bond market as we keep an eye on the equity market as we get closer to the closing bell. It's just about 10 minutes to go. Alex, stocks still holding around the highs of the day.
I mean, so far so good. Volume is really light though, so keep that in mind, right? Short and holiday trading week, but tech really the outperformer. And when you have bonds rallying as well as the dollar and technology in the U.S., it begs the question, is this the U.S. exceptional in trade coming back? Just take a look at NVIDIA, up almost 3%. And Salesforce up also, despite the acquisition.
And I just want to point out, too, I mean, I know tech is leading the charge here, but you're seeing a lot of consumer discretionary stocks, particularly those that were exposed to tariffs, really being bid up today. Names like Deckers, you're seeing a lot of the travel companies like Carnival. Maybe that's on some optimism about the consumer. So the complexion of this rally is a little bit broader than just tech.
Well, not only that, but President Trump said that he agrees with U.S. Treasury Secretary Scott Bessent that we shouldn't make T-shirts in the U.S. So maybe there will be some kind of exceptions for certain sectors, which could also help buoy and optimism.
All right. Well, let's see if how optimistic our next guest is feeling as we get closer to the closing bells. Of course, just about 8 minutes until we get there. Stocks near the highs of the day. Holly MacDonald joins us. She's Chief Operating Officer at Bessemer Trust. Holly, great to see you.
Great to be here.
We did get a little bit of a bright spot today, not just necessarily on the trade front, but we got that conference board data that did show a rebound in consumer confidence from what had been a pretty miserable 3 or 4 months. Now, there are a lot of asterisks that go into that, but any improvement, I think, at this stage would be welcome. And it's kind of a nice prelude to the big PCE data that we're going to get on Friday with regards to personal income and personal spending. Do you think that the stock rally, the tamp down in trade rhetoric, and some of the other things going on in Washington or maybe not going on is sort of emboldening consumers and investors alike right now?
I think so at the margin. I'd say overall we still are in a period of uncertainty, and until we see more of a clear resolution to the tariff discussions, it's still going to be tenuous. But days like today are a reminder that the volatility can go in both directions. And it was, to your point, a meaningful jump in consumer confidence today.
So when you get a reprieve like on the EU tariffs, and I know that's just until July 9th, you see data readings like we got survey data that's positive. Does that give you the confidence to rush back in to consumer discretionary stocks or tech stocks, et cetera?
So I wouldn't necessarily be rushing back in. We've really been invested throughout this period in making changes more at the margin in portfolios at the security level. We've also lowered our U.S. overweight since the beginning of the year, about halved it, and added some exposure to Europe. But I think this is the type of environment where you want to avoid really rushing either way. Things can change very quickly, as we're seeing even in just the last 24 hours.
So does that mean that the U.S. exceptionalism trade is there, just muted, or it's just there maybe with big tech?
I think structurally, Alex, it is there for the medium to long term. I think it had maybe gotten a bit over its skis when we got to the beginning of this year. You combine some valuation difference between the U.S. and the rest of the world, plus the higher uncertainty in the U.S. versus the rest of the world, and that caused a bit of a pullback. But I still think structurally there are many reasons why the U.S. will remain exceptional. We still have 9 of the biggest 10 companies in the world, and those large companies are still doing pretty well, and we're seeing that in their earnings so far this earnings season.
So that feels to me that that's a buy the dip on those kind of companies. Like, is that what we've now relearned?
I think so. There are some important backstops in place here, both from the policy side, from the administration itself, I think is the most obvious backstop when markets sell off too much. And ultimately, I think there's more of a backstop from the Fed too, probably not in the coming months, but let's say later in the fall, if we see some tariffs calming down a bit, and then if we were to see growth pulling back a bit as well, I think there's a Fed backstop too.
You said that you're still overweight the U.S., but you just reduced that overweight a bit.
That's right.
What about technology? Are you still overweight U.S. technology?
Slightly. Over the course of 2024, really, ahead of the tariff news, we started to pull that back based mainly on valuations, where there's some very powerful stories, but the valuations had just gotten too far ahead.
But some of those powerful stories and the outsized valuations that come with them are much more about this sort of big structural change that AI and the associated technology would bring. And we should point out we get NVIDIA earnings tomorrow, so we'll get another peek under the hood as to how things are really going here. Do you look at a company like NVIDIA and you say to yourself, it's just too rich, even though there is a lot of promise potentially for what they're selling and what they're trying to do?
We still are overweight in NVIDIA, not as prominently as we were in previous years. But when a company is growing at these astronomical rates, even if they're really not able to maintain, say, 70% gross operating margins, then this is still a name that we're going to want to hold.
Interesting. Speaking of manufacturing in the U.S., Stephen Miron, who is on Fox Business right now, economic advisor, says we can't make everything in the universe in the U.S., which begs the question, have we seen the worst case scenario? That now is just going to be sort of bringing back in the chocolate and rather than just throwing it out. That was a terrible analogy.
Chocolate?
Yeah, I don't know where that came from. But the point is, like, have we seen the worst case scenario? So from here, it's going to be much more about picking the sectors that are going to benefit the most versus pricing out good news.
I think largely we've seen the worst of the headlines on tariffs. Again, it'll be some period of uncertainty until we actually see the resolution. So still choppy, but we're optimistic that the market will remain resilient here.
What other sectors do you like?
So industrials is our most pronounced overweight. I think as companies look to shore up their supply chains, and really tariffs here can be a boon to encouraging them to do that. Their companies still have a lot of cash, and we see them continuing to put that to work on the CapEx side. So industrials, we think, can benefit.
Are you comfortable right now with where yields are at least in the Treasury market?
It's really been a broader range, I think, if you look over the last year and a half. And I think within that, from a long-term investor's perspective and primarily focused on equities, so long as we're really in this wider trading range, I think that equities can move through that.
All right, Holly, great stuff. And great to have you here on set in the studio, too. Holly MacDonald.
Pleasure.
She's the Chief Operating Officer over at Bessemer Trust as we count you down to the closing bells here on this Tuesday afternoon, Alex Steele. And I do want to go through some of the names that are moving because we talk about this idea, of course, big pops and names like NVIDIA and some of the other big tech stocks. Apple getting a nice bit. Remember, that stock was down like for 8 straight days, and they're getting a little bit of reprieve. But I think it's interesting to see a lot of these sort of consumer discretionary names, the Nikes and the Deckers, these companies that everybody had kind of discarded and saying, okay, they're just dead. Saying, okay, maybe there is life here for these names.
Right, and how much of that is just we are oversold, then you're going to buy back versus fundamental consumer confidence. I appreciate it's backward looking and quite volatile, but nonetheless. And then how much of it is like you're not going to have to source everything here from the U.S. We're going to make some kind of deals for you. And I wonder if it's the combination. But can equities keep moving higher if you're just pricing out the bad news, or do you need actual good news to then price equities higher?
Yeah, and we should point out, I mean, we're still even at 59.18 and this big, strong rally that we had. I mean, we're still below some recent highs. I'm not even talking about the all-time highs that we had, still below some of the recent highs. So we've got a lot of ways to go just to get back to square one when all this started.
But we did bounce off the 200-day moving average.
Yes,
so
that's good.
We do have some good technical support there. Yeah. It's just a matter of what's going to give us the next leg of that rally.
A live cat bounce.
Alive? Ooh, I like this.
As we break down all the market coverage, starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through to that closing bell. It's a global simulcast, and it starts now. Carol Massar and Tim Stenovec join us in the radio booth. Scarlet Fu is off today as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. 59.18 on the S&P 500. Alex Steele up 2%. The NASDAQ up 2.5%.
Yep, and there we go, guys. We keep climbing higher, bouncing off that 200-day for the S&P, Carol.
Yeah, I mean, look at it. We're seeing some buying into the close here. Quite a rally. I'm just trying to make sense of, again, what has really changed in terms of the fundamental backdrop.
Well, I guess what's changed is the EU and the U.S. are speaking, and consumers maybe were a little less stressed about tariffs, at least the portion of consumers who answered the questions from the conference board about how they're feeling about things right now.
I mean, you sound kind of skeptical.
Yeah, what's going on?
Well, look,
Tim?
you know, we talked to Mike McKee about this. He said, take this one with a grain of salt.
We will.
And look, there were also some nuances to the data. People are still very concerned about the job market right now.
Yeah, I mean, look, the labor market outlook was certainly dour, continuing to deteriorate here. But shorter term, there were people basically saying, look, we're willing and able and ready to spend money right now. And at least in the short term, that's a positive. We made a lot of hay when that thing was going down.
Yeah.
I love making hay. But I think also the difference is when you have President Trump saying that maybe we don't have to make everything in the U.S., that gives some relief to some of those retailers, right? We're not going to be making T-shirts here. So maybe there are more exemptions that are coming down.
All right, well, we get the closing bells here in New York on this Tuesday afternoon. Remember, of course, Monday was a holiday here in the United States, so it gave folks a little bit of time to kind of parse some of the negative news that came out on Friday and coming in today with some relatively positive news. The Dow Jones Industrial Average up more than 700 points or 1.8%. The S&P 500 up more than 100 points or 2%. The NASDAQ Composite up about 460 points or 2.5%, while the Russell 2000 also adding about 50 points or 2.5%.
All right, just taking a look at the S&P 500, folks. You've got most names in the index higher today, 469 to the upside, guys, and so the remaining, for the most part, to the downside. So, yeah, much more of a risk-on trade today.
All 11 of the S&P sectors were in the green on the day, led primarily by consumer discretionary stocks and tech stocks. Both of those indices up about 3% on the day. The laggards, relative laggards, we should point out, energy, utilities, and consumer staples, and they lagged because they were only up by 1%.
Where's Scarlett? I'm not used to, like, Scarlett not doing the IMAP.
Wow, are you dissing Romaine?
I
thought his stuff was just fine.
He
delivered.
He did it well. I just was like, I was a little confused.
Should I have said the spinach pie?
One of hers. All right. Now it feels like it should. All right, let's get to some of the individual gainers. All right,
pulled us there.
Okta earnings. Excuse me, I'm busy. I'm actually working here. Okta out with first quarter adjusted EPS, 86 cents a share. The estimate on the street was 78 cents, so coming in stronger than expected. First quarter revenue, folks, $688 million. That, too, is coming in better than expected, $680.6 million. Stock's down about 11%. So here's the outlook. Second quarter revenue, $710 to $712 million. The estimate is $709.8 million. Investors not loving it, guys, though. Stock down about 10%, so there's got to be a little bit more to it. So we'll wait for some more headlines to come across. In the meantime, let's do some of the individual gainers. Hologic, definitely on that list, up about 14.5%, up 25% at its highs today, but finishing with about a 14% gain. We also saw a trading pause. Top gainer in the S&P 500, TPG and Blackstone, making an approach to take the company private, offering to buy the group for more than $16 billion. This is coming from the Financial Times, signing unidentified people familiar with the matter. So definitely a standout there. U.S. Steel, also an outperformer. That stock up about 2% in today's session after CNBC's David Faber said that U.S. Steel Nippon deal is going to close probably very soon. There's been a lot of speculation after last week. There was reports from the president about a partnership, but nonetheless, we're expecting maybe some news on Friday, so we'll see where that goes. Warner Brothers Discovery, guys, it was up about 6% in today's session. I'm not sure that there was a clear catalyst. Benzinga writing that the video game adaptation of The Last of Us has been one of the most watched and anticipated series on HBO and Max since the release of its first season in 2023. So the second season's over. Everybody's looking at those viewership numbers. So maybe that gives the stock some juice. And I had to do this one. This is kind of a gift for you, Tim. Vertical Aerospace, eVTOL is the ticker, EVTL. Up about 14.5%. The company says it made European aviation history with the first ever piloted flight of a winged electric vertical takeoff and landing eVTOL aircraft in open airspace. So there you have it.
Cool.
I had to go for 4.
I just want to know how loud it's going to be. How loud is it going to be? That's the question I have. Also, pickings are really slim when it comes to decliners today, guys, on a day where you see such broad-based rallying. Bear with me, though. We got a 13.6% decline to ADRs of PDD Holdings. It is the parent company of Temu. The stock here, or the ADRs here in the U.S., fell as much as 18.4%. The company's quarterly sales and profit missed estimates, though, did highlight the impact of trade tensions between Washington and Beijing on its business. The company does face intensifying competition in the domestic China market by the shifting trade policies from the Trump administration that have hurt Temu, and will have to make pricey investments to adjust its business model that can weigh on profitability in the short term. And speaking of the Trump administration, the president's Trump Media and Technology Group, the company that he owns a good portion of shares, shares fell today by 10.4%. The company did agree to sell around $1.5 billion in stock and $1 billion in convertible bonds to buy Bitcoin for its treasury. If that sounds familiar, it's because it's exactly or pretty similar to what Michael Saylor has done over at the company formerly known as MicroStrategy, now called Strategy. Shares fell as much as 12% earlier in the session, but again closed down by about 10.4%. The company has about $760 million in cash to defend against the financial institution and create synergies for subscription payments and other transactions. Finally, talking about Savera Pharmaceuticals, its pharmaceutical company fell as much as 33% in the session, down 32% on the day. This after the FDA said the company's drug application for Molbreevi to treat patients with a rare lung disease was incomplete and needed to be refiled.
All right, I'm going to the bond market, guys. That's where the action continues to be. We saw buying all across the curve. And look at that back end, down by about 8 basis points. That was the biggest drop in yield since March. So take a look at that. Now, we had that 2-year auction. It was all right. I mean, the bid to cover was strong, but so was the high yield rate coming in at 3.95%, meaning that, like, there are buyers at what yield. They need that juicier yield in order to buy. But a lot of this was dictated by what the finance minister in Japan talked about, potentially reducing those long-term issuance within the market. And we saw a global bond rally, particularly in the back end, because of that, guys.
All right. Go ahead.
Go ahead, Carol. I don't want to interrupt you.
Yes, you do. I just want to point out a headline: Vail Resorts reaffirming its fiscal 2025 guidance. So another thing coming in. Hey, we're going to go to something a little bit lighter. Captain America, you know, Chris Evans, that kind of cute guy. Apparently he's putting, can I say that? He's putting, thank you, Finley picture.
Look at that little salt and pepper going on.
He's putting his LA home on the market for just under $7 million. It's nearly double the $3.5 million, Tim, that he paid for it back in 2013.
3 bedrooms. Nice. There's an ADU.
I'm sorry, how many?
Only bedrooms? 3 bedrooms?
3 bedrooms. There's an ADU. Okay. Accessory dwelling unit. It's got a separate entrance. It's got a bedroom and kitchen. There's a gym. That's what the ADU is now, but it could also be used as a guest house.
Yeah.
Yeah, stuff is expensive.
I love this
in this
story
area
because it really makes me feel better about living in New York City. So $7 million for a 3-bedroom house.
Yeah, but it's a 4,600 square foot house. I guess there's just a lot of entertaining space, maybe.
I guess. I mean, some people are like that.
Maybe the bedrooms
how
are
many
huge.
bathrooms? If it's less than 6, I'm not interested. Well, anyway, if you are the kind of person that can actually afford to spend $7 million on a 3-bedroom house in Los Angeles, you also might be the kind of person that can afford to hire your own private pilot. Interesting story on the terminal today about Starbucks looking for a corporate pilot to pilot their corporate jets. Are offering a salary range of $207,000 to $360,000. And the ideal candidate must have experience with the G6 and G7 type Gulfstream models.
Now, I was surprised at how juicy that price tag seemed, but you had Romain being like, what do you mean it should be higher?
Yes.
And I was like, I don't know, 360 feels super high, no?
But this also requires you to assist in handling passengers' bags, establishing security when they're away from home base, not to mention the ability to travel extensively and on a dime. Alex, I mean, if you work for an airline, if you're a senior pilot in an airline, you're making this much money. You got a set schedule. You have a lot more flexibility. But now I got to be, what, the Sherpa for these Starbucks executives for what? A measly 207 to 360?
But then you're also flying non-commercial jet.
I can't afford to buy a house in LA on that.
Versus like a huge plane, which delays and issues. You're not in your own private airport. I'm on board.
Did you see it also says that the captain would serve as a, quote, Starbucks ambassador both at home and abroad?
This is a lot. They're asking a lot for this job description.
Well, maybe you get a
here.
bonus. I don't know. They have bonuses?
I don't know.
Act with
now, the good part is I assume you get a lot of free coffee, right?
Yeah, I was going to say, I'm guessing they serve Starbucks on board.
I'm sure they, I would hope
Just
so.
an adventure of that.
Yeah. Do they have like their own barista on the plane? That would be cool.
That would be cool. Probably not.
Do you like when you go into Starbucks, you just put on the cup, Captain?
I don't go to Starbucks, but thanks.
I know you don't.
Nice. Which somehow circles back to
I don't
Chris
drink
Evans.
coffee, so it's not a commentary on Starbucks. But
all right,
I'm
that's
not
a
coffee
wrap.
Drinker.
Off to
This is Carol. It's all heart.
All right, that's a wrap. Across platform, radio, TV, YouTube.
Goodbye, family.
Goodbye. They are, of course, finishing up on television. Continuing, Alex and Romaine and Tim and I are going to go back to Bloomberg Business Week Daily. Guys, we will see you same place, same time, same place tomorrow.
Same flight.
Yeah, same flight. No caffeine.
All right, and the serious business continues right here on Bloomberg Television. A closer look at trade talks, a closer look at Washington policy. Ed Mills at Raymond James going to be joining the big program in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. Stocks here in the U.S. closed just about 12 minutes ago. An S&P 500 rallying 2% on the day. A hard bounce off that 200-day moving average that it had hit back on Friday. A lot of concerns here about whether that was the start of something new. A lot of concerns about whether this market could actually rebound. Consumer discretionary and tech stocks really helped to lead things higher here. But overall, this was about broader optimism about what's coming out of Washington. Your 10-year yield moved lower on the day, and the dollar got a nice bid for a change. Apple, really emblematic of the big moves we saw. Remember, this was a stock that had been down for 8 straight days. That was the longest losing streak for that stock going back to 2022. A 2.5% gain on the day. The flip side of that was Newmont Mining, which had been on a 7-day rally as everyone was seeking those haven bids. Remember, this is a big gold miner here, so that sold off today, as did spot gold, as well as some of the other precious metals. And then 2 interesting idiosyncratic stories here. On CoreWeave, a real battle going on right now between the bulls and the bears. Short interest on this stock right now at about 50% and rising here. The bulls winning it today. The shares rallying 21% here on the day, and they've been on a tear over the last couple of weeks. Meanwhile, Fair Isaac moving to the downside, down 11% on the day. That's after a 23% decline last week. A lot of talk right now coming out of Bill Pulte, who of course leads the FHFA here in the United States, basically criticizing Fair Isaac and some of the other credit reporting companies, saying that their fees are too high. And that actually brings us to our top story for the next hour here. And that is the light at the end of the tunnel when it comes to the months of chaos being stirred up over in Washington. Now, the chaos might not be over for financial markets and consumers, but they may actually be adjusting to it. We saw that today in a U.S. government sale of 2-year debt that was actually warmly received. We saw that in a strong advance in consumer discretionary stocks, and we saw that in a consumer sentiment report that did suggest households are back to spending money again as the trade war rhetoric gets dialed back. Still, the risk of consequences from the gamesmanship on policy, whether it be trade, whether it be high tech or higher education, are still present, and that's where we're going to focus in this hour. Ed Mills joins us right now, Washington policy analyst and managing director at Raymond James. And Ed, I do want to start off on the trade front because that really rattled markets on Friday. Of course, we came in to today, Tuesday, with a little bit of reprieve, at least a 1-month reprieve for the EU, and at least some signs here that the two sides are talking. Were you encouraged?
I'm encouraged, Romaine, but I always remind people that there is never an all clear when it's Donald Trump. The president has a pattern of escalating only to de-escalate later. And when I look at the markets, if we go to pattern recognition, in his first term, whenever he got aggressive and markets sold off, he'd reverse course up into the point where markets recovered. And that's what we got last week. Once we got kind of highs again and not a lot of progress with the EU, what you saw is the warning shot. And when I talked to clients here at Raymond James, when I was at meetings all week last week in New York City, what I heard from clients was they were trying to sound the all clear. That to me is very concerning because it tells me we have a really high risk of people being offside.
Well, that gets to this idea then, what is your expectation for these trade negotiations? It's hard to even keep up with where we are. Obviously, it's not just the EU, but whatever's going on with Japan and Korea. And we haven't even talked at all in a long time about Canada, Mexico, and some of the other big players here. Do you anticipate that we will get, if not full-on deals, at least something on paper that suggests that the two sides, whichever sides are negotiating, are actually moving forward?
Yeah, my base case here is that we're going to get a series of MOUs. And those MOUs are going to try to have a 10% across the board universal tariff. And that is going to have companies or countries, fill in what is this total dollar amounts that you're willing to purchase from the United States, and what is the total dollar amount that you are willing to provide for market access. Because I think what the president wants to do at the end of the 90 days is to be able to say, I got trade deals with more than 100 companies, and that represents X trillions of dollars worth of purchases and Y trillions of dollars worth of market access, and that's going to be good for the U.S. economy. Now, I don't think any of the real details will be fleshed out until later this year and probably into 2026. And so I caution folks that this is going to be prolonged certainty. But Romaine, the real question that I always have when it comes to D.C. is, the market going to focus on the process, or are they going to focus on the outcome? So far under the Trump presidency, they've focused almost exclusively on the process, and that process has been volatile. The more we start moving to focusing on the outcome, the better that will be for the market, and that's where we can calm down some of this volatility. We're not there yet, but we might be getting there if we get these MOUs signed with the vast majority of the GDP within the world.
Well, speaking of outcomes, there is also that unresolved issue when it comes to the budget reconciliation bill, the tax bill, if you will. I know we're still waiting for the Senate to come back and tackle the nitty gritty here. Do you actually see a chance that, at least as it's written right now, that that is going to get through in short order, meaning like within the next few weeks?
Yeah, so Romaine, what I've been telling folks at Raymond James is that May was for the House, and they were able to do this. June is for the Senate. July is to work out the details between the House and the Senate. And August is to get it to the president's desk. There are a couple of binding constraints here. Number one, the debt limit has to be lifted. Number two, this budget resolution ends on September 30th, so you don't want to get anywhere close to that. My view is that what came out of the House is probably about 80 to 90% there. But that last 10 to 20%, that's a big deal. The Senate will make changes, but I do not see a world where the House and the Senate are not able to get a deal, and this is not to the president's desk, before that September 30th deadline or before the X date on the debt limit. This gets done because the alternative is so disastrous, Romaine.
But we're already seeing the consequences of that. I mean, the 2-year sale that the Treasury had today, I mean, they had to cut the size of that just a little bit, primarily in deference to the idea of trying to stay beneath some of those constraints with regards to the emergency measures they've used to continue borrowing. And then, of course, there's the whole matter of the contours of this bill that the bond market seemed to react to last week, is basically saying, look, you're cutting taxes and not really filling that hole with anything else. And that, of course, would mean higher borrowing costs and maybe higher inflation. And if you're a bond investor, that's not what you want to hear.
Yeah, that's absolutely right. So what I've told clients at Raymond James is that 2023 and 2025 are the only two times that we have ever used extraordinary measure for a prolonged period after we've breached the debt limit. What does that mean? During that time, Treasury can't issue any new treasuries. They can do refunding, which is what we saw earlier today, what we saw last week. But once that debt limit is lifted, we have to refill the Treasury's account. We have to account for the fact that there is going to be an extra $3 to $5 trillion, the most expensive bill in the history of the United States, that's going to have to be paid for. And then we look at this debt bomb that's coming, because back in 2023, to limit that move in yields, Janet Yellen, President Biden moved a lot of the purchases to the front end of the curve. That's coming home to roost. So what can we do to bring that down? That's going to be regulatory relief for the banks, getting the stablecoin bill, maybe getting a more favorable Fed, maybe removing the asset cap for Wells Fargo. There is going to be a push and pull. So Romaine, for the second half of this year, what I've been telling clients is the biggest debate is going to be this direction of bond yields. I see a good battle that goes either way. When I ask people here at Raymond James, do they expect a 5% 10-year once we have this bill done on taxes? And it's about 50-50. It's moved up a little bit in the last week, but it is not a consensus call just yet, the direction of yields after this bill gets passed.
All right, Ed Mills, one of the best in the business, Washington policy analyst over at Raymond James, as we continue our coverage with the look of what's going on in Washington and the escalating fight between President Donald Trump and Harvard University. That's coming up next after the break. This is The Close on Bloomberg. The White House escalating its fight with Harvard University as President Trump moves to cancel all remaining federal contracts with the university. This is Secretary of State Marco Rubio orders all U.S. embassies to stop scheduling interviews for foreign student visas. Joining us right now to discuss is Bloomberg's Akayla Gardner, who covers the White House for us. This has been a long simmering feud, and I am curious, Akayla, as to exactly what the White House wants next.
Well, that is the major question. President Trump does tend to want to create these deals. You see administration officials calling him the deal maker in chief, but Harvard University doesn't know exactly what they're looking for. But at this point, we understand that after the administration has already canceled $2.5 billion worth of contracts, they want the remaining money that is still funneling from the federal government to the university to be terminated or transitioned to other universities. They value that at about $100 million. And this comes after the administration really took a move to revoke Harvard University's ability to enroll international students. Right now, that's on pause. And now we're seeing how the ramifications could potentially impact all universities, with the administration saying that they're going to start reviewing the student visa process, potentially reviewing students' applicants' social media profiles in case that there is any risk to national security and specifically anti-Semitism. And this is really a broader cultural fight that the president has been picking after several posts over the weekend.
Akayla Gardner out there in Washington, D.C. We keep the conversation going with Sarah Green Carmichael of Bloomberg Opinion, who covers politics and policy for us. And we should just point out, Sarah, of course, this isn't just a fight with Harvard. It's Columbia, it's Cornell, it's Northwestern, a lot of big universities here. And I am curious about what the end game could end up being. And more importantly, in your view, Sarah, what options these universities actually have to fight back?
These universities do not have a lot of good options to fight back in terms of the politics and the messaging and the war for public opinion. The law seems clearly to be on their side. There are processes to go through if an administration, for example, feels that students have been denied civil rights on the basis of their religion. The Trump administration is not really following that process. Similarly, it clearly violates the First Amendment to punish a university for its institutional views, for the views of its students or its faculty. So I think that what is the end game here? I think this should really be seen in the context of Trump's broader anti-elitist arguments. He can take a message to voters, and Republicans can say to voters, Democrats are fighting for Harvard, Republicans are fighting for you.
I am curious, though. I mean, and just not to cherry pick things, but specifically when it comes to Harvard, the administration made a big deal about basically a person who was awarded a fellowship at Harvard. And the idea was that he had actually been arrested at some point for something related to protests that were constituted as anti-Semitic. And we should point out no charges were ever carried through with him. He basically claims his innocence here. But they're using that as sort of one of the cudgels to go after them. And I am curious as to how much of this is real, how much of this is grievance, and quite frankly, maybe just not actually based in what actually happened.
There has been, so I would say that the administration has done a very good job of cherry picking cases that they think people will be sympathetic to. And that includes some of the studies that are being funded with federal money that maybe sound a little ridiculous. I read about one today that was like 50 grand to study caffeine drinks, which, maybe there's not a lot of sympathy for something like that. But in the case of this student, I'm sure more details about this will come out. But, that's a situation where there was a disciplinary process the student went through. And from the student's perspective, that was finalized. And now the Trump administration has chosen to reopen it. And to really fight that, the student will have to reveal their identity and potentially open themselves up to sort of a public scrutiny in a way that they potentially would not in this current environment. So I think the administration has been very strategic about the examples they have chosen to publicize.
Is there any sense here that if this does continue here, that some of these universities, quite frankly, aren't going to be able to survive? It's kind of unthinkable to think that some of these schools, as large as they are, but is that a possibility?
I think it is a possibility, and I think that is one reason that Harvard dug in its heels and is fighting. I think Harvard saw what was happening with schools like Columbia striking deals, realized, they were open to, I think the reporting has indicated they were open to striking a deal. But then they realized that there was just sort of no satisfying the administration's demands.
Yeah.
They kept shifting.
All right. Well, this story is certainly going to continue. Sarah Green Carmichael of Bloomberg Opinion. We'll be back in a moment. This is Bloomberg. It's going to be a big week for retail earnings. Macy's, Abercrombie, Capri set to report tomorrow, followed by a slew of results over the next couple of days. That includes Gap, Kohl's, Ulta, Burlington, just to name a few. Dana Telsey covers it all as the founder and CEO of Telsey Advisory Group. Great to have you here, Dana.
Thank you so much for having me.
You must be very busy. Let's get right to it. Let's first start off with the department stores and Macy's. Partly a broad story, partly an idiosyncratic story. Are you expecting to see any improvement out of them when we hear from them tomorrow morning?
Not much. You may hear a little bit about the back half of the quarter doing a little bit better because everyone got better given the later Easter that you had. But overall, the uncertainty regarding what the tariff impact could be is unsettling. I think for the department store group as a whole, it's more of a challenge time period.
A challenge time period. And you mentioned inventory. All these retailers that we're talking about here, the vast majority of them probably source a good chunk of their material from overseas. What does inventory look like right now, and how are they preparing for the potential that tariffs are going to be higher for longer?
I think what we're seeing is we're going to see a lot of the companies overall show a little bit higher inventory. They're all trying to bring goods in early so they have some of their lower cost merchandise in there so they could pass on some of those costs to the consumer. Back half of the year, it's anyone's game because the fact is prices are going to go up. What's the magnitude? And are we going to have thin shelves? I don't think as much as you think, but there could be some areas. That's why you're seeing so many companies put out new innovative product because that's where they can earn the most margin.
So just real quickly, so then on the inventory side, so if I see this press release, if you're an investor and you see the statement come out and you see that inventory elevated, you shouldn't be too worried about it, at least for this particular quarter?
Not for this particular quarter because you're going to go into the back to school time period. You want to have goods set. And overall, a lot of companies are going to start advertising back to school, for example, next week when some kids' schools.
Next week, wow.
Yes.
Okay.
Some kids' schools aren't even out of school.
Yeah, like
so
mine.
overall, I'm not worried about too much inventory right now.
Yeah.
I want to have inventory for Christmas.
What about pricing power? Are they going to have to offer more discounts than they did in the past, or do they maybe have a little bit more flexibility?
A little bit more flexibility. I don't think they need as much discounts as they have. It all depends if the consumer stops spending. What we see now, consumers still spending. They're resilient. What it means 3 months from now when prices go up, anyone's question. But the basic essential items, you can still get some pretty good deals.
Two interesting stories I mentioned. One is Abercrombie, which was a really great turnaround story. I think the last quarter they had a couple of issues. But do you see that sort of turnaround continuing? The idea that a hot brand that sort of fell out of favor has been revived, and at least on paper, they're doing pretty well, making a lot of money.
Abercrombie has two brands with Abercrombie and Hollister. The Abercrombie brand has really reset itself and had some terrific results over the past few years. Now Hollister is the one where you're seeing double-digit increases. I think we'll continue to see strength in Hollister. Well, I think you may see Abercrombie moderate a bit, but it doesn't mean that the company overall isn't going to continue to show growth.
What's going on with Capri? Obviously, that deal fell through. They're on their own. I know they're trying to make some strategic moves, I guess, to reposition themselves.
You need to fix the product. Product always is the first thing that counts. And when you have other brands like Coach, for example, selling through goods at a good price, at full price, we know that the creativity at the Michael Kors brand hasn't been what it needs to be. I expect to see some improvement, but maybe a year down the line.
Ulta Beauty.
Ulta Beauty is going to be very interesting tomorrow because overall, when you think of makeup, skincare, and fragrance, we certainly have seen some of the nuances that they have. When you have they're the exclusive provider of Beyonce's new shampoo, Milk Makeup just launched. You have some drivers that could be exciting for them. Is it going to be enough with the other categories is a question. But I think overall, when you think about 2025, I think Ulta could do a little bit better than expected.
Oh, really? Interesting. All right, I saved the best for last here. I got to ask you about Kohl's. This is obviously a mess. They had some issues, obviously, with their executive leadership for personal reasons. Where do we stand right now? And this was a company that was already struggling even before the departure of the CEO. Where do we stand right now?
I think what you said is perfectly appropriate. It's a little bit of a mess right now. When you have a company overall that has a debt payment coming up, which they say they're going to make, that just began to close some stores and probably needs to close more, has had 3 CEOs in a year time period, it's a little bit wobbly and uncertain, even with having Sephora in the front of their stores. So overall, I think the off prices are continuing to take share from Kohl's.
Off prices, and would that include something like Burlington, which also reports this week?
They report on Thursday. Burlington, TJ Maxx, Ross stores, you have good brands at Kohl's, but it hasn't driven enough traffic and ultimately conversion.
I just have to, before I let you go, I mean, I've been covering Burlington for a while. I never really knew the whole origin story, and the founder of that company recently passed away, and I did a whole deep dive. There were some great stories just about how he founded that company, and just one little store out there, out there in New Jersey, and then becomes this multi-billion-dollar brand. I mean, you've covered this company a long time. They still have that mojo?
They still have their mojo, if anything, with Michael O'Sullivan as the CEO. They've basically signed up for a higher rate of revenue growth in the future, and with the better locations they're getting, taking some of those Bed Bath & Beyond boxes, first-year sales are running above plan for those stores. Yeah, it's interesting to see some of the, I mean, they're very prime locations, and particularly in New York City and beyond. Dana, always a great conversation. Thank you.
I'll let you get back to work. Dana Telsey is the founder and CEO of Telsey Advisory Group. All right, we're going to keep an eye here, of course, on those retail earnings. Full coverage on Bloomberg starting tomorrow morning on that. But when we come back here on The Close, we're going to go back in history and take a closer look at the tech space. 30 years ago today, when Bill Gates fired off one of his most consequential memos, predicting an internet tidal wave. That discussion coming up after the break. This is Bloomberg. All right, let's take a look back in history to 30 years ago this week when Microsoft co-founder Bill Gates warned of an internet tidal wave that threatened the company's existence. Now, at the time, Microsoft was the 800-pound gorilla, having helped pioneer the consumer-friendly operating systems that powered the vast majority of personal computers. But by 1993, the World Wide Web was emerging as a force that let people connect to one another without the byway of an operating system like Microsoft Windows. Gates in 1994 began to push his developers to create a web ecosystem that could be integrated into Windows, but progress was slow. Then on May 26, 1995, top executive received an email from Gates titled, quote, "The Internet Tidal Wave." In it, Gates complained that he had spent 10 hours browsing the web and found almost no Microsoft file formats. He instructed his executives to remedy that, and fast. Make Microsoft software the standard for material on this internet. The 9-page memo specifically cites a, quote, born on the internet company called Netscape, a barely one-year-old startup that was 3 months away from one of the biggest IPOs of the era. Gates worried that Netscape web browser would make Windows irrelevant. A day after Gates' memo, Benjamin Slivka, the project leader for the yet-to-be-released Internet Explorer browser, sent out a memo himself titled, "The Web is the Next Platform." Now, these two memos led to a momentous meeting of developers on June 1st, 1995 at the Bellevue, Washington Red Lion Inn. They set out to brainstorm strategy. Now, there's a lot more to this story that can be told in just 2 minutes, but the August release of Windows 95 included bundled software for MSN and Internet Explorer. And the rest, as they say, is history. Well, sort of. A lot of parallels can be seen today with the emergence of artificial intelligence. But instead of competition from Sun Microsystems and Lotus and Netscape, today it's OpenAI, Anthropic, Perplexity. And just as Windows in the 1980s changed the way we interacted with computers, so too did the internet in the 1990s. And now here in 2025, the adoption of AI promises the next big tech transformation. The only question really is whether the companies will be able to ride this AI tidal wave to prosperity and which companies will actually get buried by it. And of course, one of the biggest stocks in that space riding that tidal wave is NVIDIA. The shares had a nice rally today ahead of its earnings report tomorrow after the bell. And here to share his outlook for what he expects out of that report and beyond is Doug Clinton. He's the CEO and founder of Intelligent Alpha, and he still believes NVIDIA ranks at the top of the Mag 7 when it comes to AI opportunity. All right, Doug, I mean, the numbers themselves are almost inconsequential. Phenomenal revenue growth, phenomenal profitability. When you look at going forward, the release of these new Blackwell chips, and of course, the broader adoption of AI itself, NVIDIA, in your view, remains on top.
It does. And I mean, remain to the point of using AI and AI transforming everything in the world. We use AI at Intelligent Alpha to do our portfolio management. So our AI systems really believe in what's coming from AI, and they think NVIDIA is the best way to play that wave. And I don't blame them. You know, you look at sort of everything we heard from the hyperscalers over the past quarter. Everyone to a T said that they are continuing to spend on CapEx. Meta increased their CapEx guidance. So coming into the quarter tomorrow for NVIDIA, you have to feel pretty confident that the numbers are going to be at least okay. And then on top of that, I think you have some of this optionality with, can they maybe get back into China with some recent reports? And that might help the stock continue to work from here.
Yeah, I am curious about that. And we should point out the estimates, at least the Bloomberg consensus estimate, $43 billion in revenue for the quarter, adjusted gross margin at 71%. And of course, they have released those new Blackwell chips, but a lot of questions concerned about whether they can actually get back into China with those other chips here. Do you have any expectation that some sort of a deal will be worked out with the Trump administration to allow this?
I certainly don't think we'll get much of a sense for that tomorrow. I mean, obviously, the real, I think, catalyst for this is not can NVIDIA build alternative chips. Reports from yesterday suggest they've already sort of done that. The question really is, will this administration sort of lighten the export controls that they have on those chips and just allow them to sell them into China? To put it in perspective, I think when they were disallowed from selling the H20 chips that they used to sell, they wrote down $5.5 billion worth of those chips just a month ago. It was probably about a $15 billion annualized hit to revenue or so. So it's still a really big opportunity for them. And even if they're coming back to the market in a smaller way, potentially with these new chips, you might still have kind of a $10 billion kind of upside. I do think we'll find a way that NVIDIA will be back in China, but my guess is it takes a couple of months before it happens.
So, and we're talking $15 billion. That was, I think, the 2026 sales projection, the $15 billion hit here. And that's just on the H2O restrictions, right? That doesn't take into account anything else?
That's correct. It was really focused on those H20 chips that were officially sort of banned, and then they wrote them down as a consequence.
So where do we stand right now with the GB300s? Is that still part of the discussion as well?
I don't know that those are going to be part of the discussion, because it sounds like really what's happening is they're sort of taking the overall Blackwell architecture, and what's coming out of their new sort of, cut down version of that will replace potentially this H20. It may even be lower powered than what they were previously in market with. And so I wouldn't really comp it necessarily to some of the things that they're selling in the US in terms of the Grace Blackwell chips, that are sort of built in for data centers to just be installed. I think they'll probably look something different than that. And some of the reports we've seen have talked about kind of a $6,000 to $8,000 potential sales price. That kind of gives you a sense when you're comping that against, $40,000 a chip for stuff in the US, it is going to be significantly different.
There's been a lot of talk as to how long NVIDIA can keep this going with regards to the sort of relentless demand for their chips. We just, of course, last week had a deal announced with regards to Oracle. There was whatever that deal was struck over there in the Middle East during Trump's visit there here. At some point, this growth has to slow down, right, Doug? I mean, I know there's an addressable market here that's pretty vast right now, but at some point they're going to hit that limit. When do you start to get worried about that?
I think it can probably last longer than many investors think. And if you look at the street numbers, we're kind of getting into that sort of mid-teens kind of growth into next year off of obviously the last year where we've grown well over 100%. So I think some of that is already baked into numbers to some degree. But I think you have to go back to some of the commentary we keep hearing from these hyperscalers. Meta has said it, and Google has said it, OpenAI has said it. They've all mentioned that demand for them is really off the charts. And in many cases, they're not able to serve all the demand that they're getting from customers right now. And so I think you're going to continue to see them needing to build new data centers, more data centers focused on inference, so really delivering on those demand queries from users. And I think that could give a longer tail to this NVIDIA tailwind than most investors are probably thinking.
With regards to inference, and there's been a lot of talk about this idea that what it takes to sort of build up these systems, these large language models, requires a level of computing power that is much higher than what it takes effectively to maintain them, at least when we're talking about inference here. How does that factor into your outlook for NVIDIA? Does that mean a drop in revenue? Does that mean, is there a refresh cycle that maybe they can capitalize on? How do they fit into all that?
Not necessarily a drop in revenue. I think there's a couple ways you can think about that. In some cases, right, chips that you were previously using for training, you might repurpose them for other use cases, and some of those use cases may include inference. You may build inference dedicated stacks and data centers. And so it kind of all, I think, fits together in the general guise of there's just this huge demand for additional compute. Once the training is done, right, that is sort of a discrete time-bound activity where you're building a new model. Then you have the ongoing and persistently growing demand for using that model, and that's really where the inference comes in. And so I think it's something where you can have those training dedicated clusters, but then you need to make sure you have enough on the other side to support inference beyond just having stuff that's training that's repurposed.
All right, Doug, always appreciate you taking time for us. Doug Clinton is the CEO and founder of Intelligent Alpha. A preview here of those earnings out of NVIDIA. We'll have full coverage right here on Bloomberg Television tomorrow after the bell. And we'll also, of course, have a special coverage starting at 6:30 p.m. Eastern Time, a special interview with the CEO, Jensen Huang. Meanwhile, here in U.S. markets, a great way to start the holiday shortened week, a 2% gain on the S&P 500, a 2.5% gain on the NASDAQ. The Philadelphia Semiconductor Index rallying about 3.4%. And of course, a lot of that had to do with the big impact of NVIDIA. As NVIDIA goes, so too does the market. And that will be a big determinant of what these numbers look like tomorrow. Yields down on the day. Bitcoin holding around that $110,000 mark. We should point out there was a modest bid coming into the dollar and a pretty strong bid coming in to long dated treasuries. This is The Close on Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation.
It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JPMorgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
The only thing that's done better than private equity, honestly, if you go back, is sports valuation. So I'll just throw out the NFL numbers. The Bills, $1.3 billion, $1.4 billion. The Panthers, 2.2, 2.3. Broncos in 2022, 4.6. Us at 6. And now, so that's 4x in 10 years. And now you start to hear about some of the things, and I think there'll be trades even higher.
And that is Josh Harris. Of course, he is the owner of the Washington Commanders NFL team, and discussing how high NFL valuations could go during his conversation in the latest episode of The Deal with Alex Rodriguez and Bloomberg's Jason Kelly. Pleased to say Jason joins me now here in Studio 2. All right, it's better gains in sports than what he saw in private. And we should point out, he co-founded Apollo.
That's right, yeah.
He founded one of the greatest private equity firms ever to exist. So,
and made a lot of money doing it. Made the sort of money that allowed him to buy big sports teams.
Okay.
But he's making more, I mean, potentially in sports. Isn't that amazing?
Yeah.
And how fast they're growing. I mean, you think about values quadrupling in 10 years.
Yeah.
You don't get that anywhere but sports.
Well, and I am curious, though, as to how much further he thinks it can go, because we talk about this idea of these high valuations.
Yeah.
Sometimes people will look at that and say, okay, this must be the peak.
Right.
And you're going to get left holding the bag. But he doesn't feel that way.
He doesn't. And it's funny you say that because, you know, one of the jokes that he's made over the past couple of years is he pays $6+ billion for the Washington Commanders, and he's like, and I lost all credibility as a value investor when I did that. And yet, Romaine, what's crazy is we've had trades since then for the Philadelphia Eagles and the Miami Dolphins for minority stakes that have valued them at $8+ billion.
Yeah.
And right after that clip that you just showed, I asked him, $10 billion on the horizon. He said maybe not right away, but of course, we're getting there.
And we should point out, I mean, $6 billion for the Commanders. He's about to spend a little bit more money because now he's going to build a whole new stadium complex on the old RFK site, I believe, right? In Washington, D.C.
So this is a $4 billion deal that he struck with Mayor Muriel Bowser down in D.C. She's going to put in 1.1 or so D.C. as the Commanders are going to put in $2.7 billion. Wow. Gets you close to $4 billion that is going to go into this. It's going to be an iconic piece of sports stadium. You know, it's going to go into the history books and could lead to Washington hosting a Super Bowl, which would be crazy.
Well, that's I used to live in Washington. That was always the thing because both of the stadiums, RFK and then the one they played out in Landover, Maryland, were kind of open air. There was a lot of concern. You can't really have a Super Bowl in February in a city like D.C. But this now opens a door for that, and it's going to be brand spanking new, which I know the NFL loves.
Brand new. They love that. They love to come there. The NFL draft, Josh Harris and Roger Goodell went to the White House and said 2027.
That's going to be on the National Mall.
Exactly. They're going.
That's like where they have inaugurations.
Exactly. Well, I mean, it's an inauguration of sorts if you're, you know, the number one. So that's coming in 2027, and Roger Goodell has said this dramatically increases the possibility that Washington gets a Super Bowl.
All right. So this episode. So if I want to watch the full thing, when can I do that?
You can do that tomorrow night on Bloomberg TV on Bloomberg Originals, and then you can listen to it on podcast starting late tomorrow, early Thursday.
Yeah, I watched I think the last episode. You got Melody Hobson on. You got anything else good coming up?
So another owner of the Commanders, actually, Magic Johnson. You and I were out at Milken. We got a chance to sit down with Magic in front of a live audience. Alex and I did. And he talks a lot about the Commanders, says it's the best deal he's ever done.
All right. Well, I'll definitely be looking forward to that. And I actually really loved what Magic had to say on stage and really the interplay between him and A-Rod. A-Rod basically was mentored by Magic when it came to
unbelievable relationship.
All right. Great show. You got to check it out. It's called The Deal. It includes Jason Kelly there and, of course, Hall of Famer Alex Rodriguez. Yeah, I said it. All right, let's take a quick look here at what could potentially move the market over the next 24 hours. A lot of earnings on tap, including Macy's out before the bell. Dick's, Abercrombie & Fitch also scheduled to report. And then after the bell, this is where all eyes will be. The biggest stock in the world, NVIDIA, set to report after the bell tomorrow. We're also going to get some earnings results after the bell out of Salesforce, Synopsys, Elf Beauty, as well as HPE Inc. Now, in between all that, there will be some macro news that you do have to parse. It includes the minutes from the last FOMC meeting that comes out at 2 p.m. Eastern Time. And we are expected to hear again from Minneapolis Fed President Neel Kashkari. We'll have full coverage of all of those events as soon as they happen, right here on Bloomberg Television. I want you to stick around, though. The team at Balance of Power is coming up next for all your coverage out of Washington. That's coming up next, right here on Bloomberg.